Welcome everyone to the 2021 Connors Wealth Forecast event. We thank you for joining us today, especially given what a challenging environment we've currently been living through. This event normally is a live event where we can see everyone in person and you can meet with our entire team. And we do miss those events very much and we look forward to resuming them in the near future. In the meantime, we wanted to do something special for this virtual forecast. And let me tell you, I think we've achieved that. It's my pleasure to introduce Professor Jeremy Siegel, the Russell E. Palmer Professor of Finance at the Wharton School of Business at the University of Pennsylvania and the Senior Investment Strategy Advisor at Wisdom Tree. He graduated from Columbia University in 1967 and received his PhD in economics from MIT in 1971. He spent 1 year as a National Science Foundation postdoctoral fellow at Harvard University. And Professor Siegel taught for 4 years at the Graduate School of Business at the University of Chicago before joining the Wharton faculty in 1976. You've seen him on CNBC and all the other networks frequently. He's a regular columnist for Kiplinger's and has contributed articles to the Wall Street Journal, Barron's, the Financial Times, and other national and international news media. He's also authored 3 books, including Stocks for the Long Run, which I just read last weekend. Great book. I highly recommend it. His awards are numerous. He's an icon in our industry. I could go on, but I'd rather have you have more time with the professor. So with that in mind, it's my honor to introduce Professor Jeremy Siegel. Sir, it's all yours. Thank you.
Justin, thank you so much for that introduction. And I'm really honored to be with you this afternoon with all that's going on in the market. I'm going to give you a little bit of a summary of where I stand on many issues, but I want to take your questions afterwards. Let me just begin because Justin talked about my background, and that's very important in terms of informing my forecast. I got a PhD in economics with a specialty in monetary theory and policy, but most importantly, my first teaching position was at the University of Chicago, where I was actually a colleague the last 4 years at Milton Friedman, was a faculty member. And his influence on me was very, very strong in terms of understanding how the Federal Reserve and central banks influence not only the economy, but also the financial markets. And I remember him telling me that as important as the Fed is, and the Fed is so important, look at the monetary statistics. If you want to understand what is going to be happening to the economy, you have to understand what is happening to money and liquidity in the economy. And I have a few slides I just want to share with you to help you understand where I'm coming from and where I think we're going as a result of the unprecedented amount of liquidity that has been added to the system by the Federal Reserve and the federal government. So we're going to just do a few slides here. So I'm going to go into share slide mode over here. And there we are. So this is last summer. This is the M1 money supply. What is this? This is money that is in checking accounts, in payroll accounts, corporate accounts, transactions accounts, now accounts. Money, the most liquid money that people have. Last summer, I saw, the pandemic really began in March. Look at the kink in the money supply. There's a logarithmic curve. So I had never seen that surge before. 40% from March to June. Just to give you an idea, I went all the way back to the financial crisis you see on the left-hand side of that chart. And the entire year that followed the bankruptcy of Lehman, we had less than 20% increase in the money supply. Not only that, I looked and compared the money supply increase in the United States with that of the rest of the world, and it was far more than twice that occurred in almost any other country in the world. But if that's not all, let me show you a new slide. This I only prepared about 2 or 3 weeks ago. Actually, it was featured in an op-ed piece in the Financial Times last week. Financial Times emailed me, said it was the most referred to piece in the entire Financial Times on that day. This is a 150-year history of the money supply. The money supply is the dark line here from 1870 to the present. The increase in 2020 in the money supply was greater than the increase we have ever had before in our history. It is just unbelievably dramatic. The red line is inflation. Inflation usually lags a year or so behind the increase in money. And this at the bottom is the difference between the two. We are now at a record difference of the two. I went on CNBC last May and June and said, we're going to have inflation next year. No one believed me. We were having deflation. Oil was going to zero or negative. I said, wait until the pandemic's over. We get vaccine therapeutics. We're going to have one of the biggest booms. First, it goes into the financial markets, the liquidity, and then it goes into the economy. And that's what I said. No one, now it is interesting how many people are talking about, oh, we might have inflation this year. Now let me say the following. I'm not talking about hyperinflation. I'm not talking about double-digit inflation. I'm talking about inflation of 3, 4, 5% a year, though, which is about double what we've had in the last 2 decades. And you know what? That is a sweet point for stocks. Stocks do very well in a 2, 3, 4, 5% inflation environment. They don't do well in a really high one, and they don't do well in a low one. That is a sweet point for stocks. All right. Now, what I'm going to do now is, if I can do this, I'm going to go right to our last slide, which is my conclusion slide, because there's so many questions that we want to answer. I want to get to the main points and then supplement that with other slides. So let me get to that very last slide. And we're going to go to some of the other slides later on. But I want to get to this slide, which are implications for investment strategies. All right. Well, I've already said it. I'm going to say it again. The liquidity provided by the Fed and the government policy is going to spark an extremely strong economy and rising stock market this year. I think value stocks, we know they've had a really tough time, but they're going to outperform in this year for 2 reasons. First reason is the reopening of the economy. Secondly, and this is really important, the search for yield. Bonds, I'm going to talk about, that's another point coming up. Treasury bonds are going to be the worst performing asset class in 2021 and 22, I think. You cannot get it in the bond market anymore. People will be looking for dividend-paying stocks as the source of inflation-protected income going forward. The Fed is going to keep the short-term rates near zero, but they're going to let the inflation rate run well above the target because times are going to be good, and they're going to try to absorb all the unemployed back in the economy. Now, people say the unemployment rate is only 6.5%. Let me give you an interesting statistic. We've had so many millions of people drop out of the labor force that if the same number of people in the labor force last February were in it today, the unemployment rate would be 9.5%. We need to absorb a lot more people in the labor force. We need to run this economy hot for a long time. Well, let's put it this way. The Biden administration isn't going to let this economy run hot for a long time. And you got to protect yourself against that running hot. And the way to protect yourself against running out of hot is to be very wary about bonds. I went on CB and CNBC in June and made the following pronouncement. It is a gutsy one. I said that the 40-year bull market in Treasury bonds, yes, 40 years. In 1981, the US 10-year Treasury was over 16%. And it's gone down, yes, a couple little blips, all the way down to last year, we hit 0.5%. And that's the low. I think no one watching this today will ever see it lower. In fact, maybe not even our children will ever see it lower. Maybe this last year. You know what people are going to be asking themselves? What were people thinking buying 10-year non-protected inflation dollar bonds at 1.5%? What were they thinking? By the way, I have to tell you, they asked the same question right after World War II when they were buying them 1.5% and 2%. Inflation was running at 15%, 10, 5, everyone coming back. The Fed had provided huge amounts of liquidity right after the war. Debt levels had risen very high. We had a great economy. Did you want to be in bonds? No, you did not. Now, there's no question that this pandemic makes for permanent changes in the economy. Technology, definitely. I mean, we couldn't be doing this presentation without it. We know how great it is, but let's face it, it's pretty priced into this market. I think, however, you know, this is going to change us forever. Commercial real estate down forever, office buildings, business travel down, personal travel go up. Everyone's going to, and they're going to go back to restaurants. We're going to do everything we want to do, but we now see all the advantages of how we can do things differently. History shows you when you're pushed to a position, you don't like it at first, but you learn, and some things are better than what you had before. You go back to a lot, but some things you say, hey, you know what? You know, doing it this way is better. That is going to happen here in the pandemic. Productivity and profit margins are going to expand. Right now, the expectation is, giving you some valuation, that the S&P 500 operating earnings are going to be $166 this year. Already people are saying that's too low. By the way, that's about 22 times earnings. I think the long-term is, you know, should be about 20 times earnings. I think we could have 175 to 180 this year. As inflation goes up and the economy booms, I think the number of beats is going to be huge. I think we could easily have 180, 185. We're at about 20 times earnings, which is exactly where we should be going forward. A lot of firms got rid of the excess employees that they were able to hire during the big boom that we had from 2000, the financial crisis, 2008, all the way to 2020, which was the longest economic boom in U.S. history. And they got rid of a lot of them. And they're learning how to pare down costs down to the minimum. This is great for profits, to say the least. All right, little bit of politics here in terms of taxes. Dems taking Senate, we're definitely going to have higher taxes. We're definitely going to have a higher corporate tax. We're going to have a higher personal tax at the top range, not at the middle or bottom. We're going to have higher capital gains. We're going to have higher dividends. However, we are not going to have the entire Biden program, not with a 50-50 Senate. I think Biden will get about half of his taxes through. He will get them through. Some of them will be applicable this year. I don't know which, but not many. cannot afford to harm the economy much when the unemployment rate is high as it is. Most of them, I believe, will be effective in 2022, not 2021, but some might be retroactive, perhaps to July 1st. We don't know yet what's going to happen. But I do not believe the entire package of tax increases is going to go through. But you will have a tax increase passed this year. I am 98% certain that that will happen. I think that we're going to have higher spending. I think we're going to have an infrastructure bill. So we're going to have a boom. Bonds are in the 3, 4, 5% inflation that I predict are terrible choices. I think the dollar is going to continue to go down. I've been a dollar bear now for 6 months. So don't give up on your international stock allocation. I know it's been painful. I know it's underperformed over the last 5 years. But I think with a declining dollar, and particularly on the emerging market front, one has to remember commodities are going to do better. And they're already doing well. CRB index is already virtually to the level it was pre-pandemic. And that's before all the spending kicks in. Emerging markets do well when commodity prices go up. And I think emerging markets are very attractive. They are now selling at around 16 times earnings. And of all the major areas in the economy, they are the lowest PE ratio. Let me mention a couple of other issues because I know they're going to come up. On Bitcoin and what's going on now with GameStop, the Reddit and some of these chat rooms. First on Bitcoin. It's a very interesting phenomenon, but I want to give you a couple of important facts. We do not have our financial system set up properly in the US. We could transfer money from merchants to individuals and between individuals at 2 to 3 basis points. That's hundreds of a percentage point per transaction. I mean, almost instantaneously, you know, like Venmo and, Zelle, which is another. We could do that for all of them off of our phones instantly. But we have a crazy system where the credit card companies, Visa, MasterCard, American Express, come in, they charge the merchant 2.5%, and then they give us back 2 in cash. That's crazy. We should really have a system where we just do total transfers and we get the 2%, not the credit card company. That's what they do in China and other countries. Now, after having said that, let me say that transactions cost that they can do that with, Bitcoin cannot compete with that. Bitcoin does not have and cannot have the technology to do that instantaneous millions of transactions at no cost. Oh yeah, they can beat 2.5% of the credit cards, which is stupid anyways, but they can't even approach it. So is Bitcoin a future medium of exchange? You decide. Let me tell you something else. If current laws are enforced, what do I mean? Reporting capital gains and losses. Every brokerage firm must do that. If current laws on money laundering are enforced, Bitcoin would go down 90% in value. No new laws, just current law. Every time you buy and sell a Bitcoin, you have to report a capital gain or loss. Of course, there's been capital gains. Those have to be reported to the IRS or you are guilty of tax fraud. How many people are guilty of tax fraud? Okay. I could go on about Bitcoin if you want me to. Is it been a good store of value? Beautiful. Has anything gone up more? Beautiful, yeah. Is it the future of transactions? I'll let you decide the answer to that question. Yeah, crazy kind of what's going on in the markets, GameStop and all the rest. The important thing here, and there's speculation, is this has not hit the general market. The only stock, and this is very different than 99, the only stock where you could question the valuation, and there is, and it's not out of the question, but Tesla has to beat every other car producer by a big margin into the future to justify its price, and it might do that. But that's the only other one. Nothing else to me is crazy. Nothing of the big stocks. GameStop, is crazy. There's a few more that are crazy, yeah, but these are trivial. This is not the market. What we need to do, there'll be a lot of losses, and we need to convert these. I'm glad there's a lot of young investors. We want to convert them to real investors. A lot of speculators. They're not investors yet. They're speculators. We need to convert them to investors. And we need to have a caveat emptor. Be a buyer beware. You're speculating here. That's we need to do that. And hopefully these people, after licking their chops and taking some losses, will say, you know what, I really want to get into the game. Because let me tell you, stocks are a game that has a positive long-term return. The odds are with you in the long run. I've done the research. As Justin pushed up the book, that the 200-year history, average return 6.5% after inflation. It can be a little bit lower into the future. I predict 5% after inflation. But still, you go in casinos, you're going to lose money. You might enjoy it. You might, because it's gambling, and might have a lot of fun, but you're going to lose in the long run. You're going to lose on GameStop in the long run. You're going to lose on all these things in the long run that you push up way beyond their fundamental value. Okay, if you enjoy doing it, take your losses, fine. You want to get something that has odds with you, you got to be an investor for the long run. You got to be an investor. So I just hope, I don't want to, clamp down on the market. I just saw just a half hour ago, Elizabeth Warren was on CNBC talking about a wealth tax, talking about all sorts of crazy stuff. Now they're calling for congressional investigations and all the rest. Yeah, there can be some people burned, and we need to be able to say, hey, come over here. You want to have some money to have fun with? Go use that for fun. Maybe 10% of your portfolio, 20%, how much you can afford. But you want something that's going to give you the huge gains. You want to, that's going to set you up for the long run. You got to be an investor, not a speculator. That's a message we need to give to these younger people that are, speculating on Robinhood. A lot of them know that already, but a lot of them do not. And I hope that we get to that area. With that, I'm going to stop the share, and we're going to go down to looking at it, but I may go back to some slides as our questions continue.
All right, that's great. Well, that was a lot, but it was summarized. I appreciate that. And you pretty much covered almost all the questions that came in earlier. Before I get to those questions with the advisory board, I think that where you were with your commentary there, why don't we address that question where bonds are actually riskier than stocks in the long run, right from your book and from Nick Murray's book. Ultimately, the understanding that you may have a year where stocks don't work and, all of a sudden, you struggle with that risk management. But if you can take the emotions out and just focus on the longer term, there is no better place to be than in equities.
Well, let me show you. I'm going to share a screen again so that because we've done our own research on that. And let me show you this slide over here. So, Justin and everyone, can you see this slide?
Yep, we can see it.
Yeah.
And by the way,
So
if
this was
anyone-
prepared. I'm a senior advisor to Wisdom Tree, and we are devising retirement portfolios, and we've done a lot of research on this question. And what we have done here is analyze the probability that you're going to run out of money in a 30-year retirement portfolio. Given, well, we did two cases. One where you have a 4% draw, which is 40,000 per year out of every million that you have in the portfolio. And the other is a 50%, 5% draw, $50,000 a year out of every $1 million in the portfolio. The probability of running out of money is on the 4% draw are the red bars. This on the left represents all bonds, no stocks. On the right, all stocks, no bonds. The normal portfolio was this 60-40 portfolio. But you notice that our simulations, and we did thousands of simulations using actual returns, historical returns, crashes, panics, and everything, that you actually on a 4% draw run out of money. The probability of running out of money is lower with a 75 stock, 25 bond portfolio than it is with a 60-40 portfolio. If you have a 5% draw, actually the probability keeps on going down. Now this is something that it was very, I had a hunch this would happen, but it was very surprising. Normally, the more stocks, people think the more, well, I got some bad markets, I'm gonna maybe run out of money. But the income difference today is so high between stocks and bonds that by relying on bonds, you're actually increasing the probability that you will run out of money. Right now, bonds, TIPS, even if you want to protect yourself from inflation, so you buy the TIPS bonds, minus 1% on the 10-year TIPS. My prediction on stocks is 5% after inflation, minus 1 after inflation in TIPS. That 6% gap is huge. So this result shows you that actually moving to a more stock-oriented portfolio might actually be a safer option than sticking with a 60-40 portfolio. Okay, right. I will go back to our major screen.
And basically, you just have to endure a little bit more volatility. I mean, that's...
Yeah, I mean, the stocks are, you're always going to go through those volatilities, but the income difference is just enormous.
It's huge, yeah. And that's the conversation we're having with our clients right now in terms of reallocating that bond portfolio. So with that, I'd like to bring our first advisory board member on, Rick from Cocoa Beach, Florida. He has a question for you, so we're going to turn his mic on. Rick, are you there?
I am. Can you hear me?
Yes, you can.
Great, Dr. Siegel. Thanks for helping us get better here in the Central Florida district here. I got a couple questions, but I'm going to just kind of put them together, and you can handle it like that. You mentioned a strong economy and stock market for 2021, and so what do you see as the best opportunities for the rest of this year, which is a long time, and maybe in 6 months or into 2022 to help investors with a conservative risk portfolio, which a lot of us in Florida are older and
Sure,
retired.
I understand.
That-
Well,
that-
again, I go to the dividend, I mean, I go toward the value stocks, which are not inflated. They're very reasonably priced. I would go to the dividend payers. The dividends are going to be the source of your income. They're protected against inflation in long run. You're not going to get it in the bond market. You're going to get it from the dividend payers. That's going to be the source of income for you in the future. And by the way, international stocks, we pay higher dividends than US stocks. Do not give that. You can get dollar dividends from your international stocks as well. That's where I think that income is going to come and the growth is going to come.
Okay, great. Any recommended selections?
No, I'm actually not a stock picker or a sector picker. I'm a macro guy. So as a result, I'm giving you the big look over here.
My last question is, what new opportunities or risk in investments do you see with the new administration as agenda going forward? We've made a complete 360, 180 change, however you look at it, from the previous administration to today. You mentioned the taxes will probably rise, opportunity will rise on the market. So how do we posture ourselves to that?
Well, with more inflation, you got to have real assets. Stocks are real assets. That's one thing. Therefore, you got to get your income from real assets instead of money assets. That is another thing. Infrastructure, we're going to have infrastructure. There's going to be a bill. I'm not going to tell you which stocks are then the ones, but we're going to have a lot of spending. There's a lot of work that needs to be done on our infrastructure. And we're going to have a lot of infrastructure. So there's going to be a lot of business activity, a lot more profits, but Biden's going to take some of that away with those extra taxes. That's going to happen. But net, it's still positive, very positive for the stock market. Liquidity, as I said, that has been provided is very positive for the stock market.
Great. Thank you very much.
All right.
Well, thank you.
Thanks, Rick. And Professor, along those lines, I think, what Rick was talking about and, what investors struggle with that are have a problem when the bonds aren't paying the dividends. And on top of that, they got interest rate risk as well. But then you see the dividend stocks last year relative to the growth stocks never recovered.
No, they have
down.
not yet. Value has only, they're beginning to recover.
Yeah, now they are.
Now they are.
Yeah.
Because we've had a huge surge in growth versus value because of how technology has gotten us through this. But I think that's priced just into the market now. Yeah. We're talking about going forward, not talking going back. I'm not going to argue that growth dividend-based stocks did better than the growth stocks the last year. Of course not.
Yeah.
But what about the reopening of the economy?
Oh, we totally agree. I mean, we think the opportunity is there, but when you're an investor and you have an equity income bucket that's down 9% when the market's up 15 and there's a spread 50% between growth and value, they start to ask questions like,
I know they do. I know they do.
Our job's to help them keep that discipline and not
absolutely. And it is very hard. Yeah. It is very hard. Let me go to another chart, but that might illustrate that. So I'm going to do another share screen over here that I think will help you on this, and that is this screen over here.
Yeah, it's crazy.
This is a screen of growth versus value, and there have been three extremes over the last half century. The first was the Nifty 50 extreme relative valuation of growth and value. This is when institutions, there were 50 stocks that all institutions bought. They said they can never lose. There were the IBMs, Standard Oil, Avon Products, Polaroid, Eastman Kodak, a lot of them did fail. Didn't matter. They did, and they went to 60, 70 times earnings. Second one was the dot-com bubble. We are now over here.
Yeah.
Now, I'm not, just look at this. I'm not saying that we're going to have a crash of growth stock. I don't think we will. And I still think there's some opportunities in some of them. And I do think actually that some of the biotechs are going to do well. But nonetheless, you look at this chart and it tells you, you know, you would have all said, oh my God, what did I do? I've underperformed 15%. And then look what happened, Zoom. That's what discipline is.
Yeah.
And that's what produces those better returns.
Yeah, and that's our challenge, is to keep the investor disciplined and diversified, so they're not chasing the shiny object. And we talk about that in our videos. And you know, right now the shiny object is the big five and the COVID economy stocks, and you know, other kind of themes du jour. But at this point, you know, we do believe that those stocks, as well as the small caps and the international and the emerging markets, all offer compelling opportunities. But, you know, having a basket of them and not trying to be so focused, I think last year really caused investors to get really concentrated into a few parts of the market. And, you know, it may have worked and good for them, but that's also the risks, you know, and that's that.
Mm-hmm. No, for anyone who shifted, I give them credit, but, you know, nothing works forever. If you're not, you gotta be changing. We're talking about going forward, not backward.
Yep. Yep. Ideally. So next question, advisory board member Jim, Cocoa Beach, Florida as well. Jim, go ahead.
Hey, Justin.
How you doing?
Siegel, how are you?
I'm good. Thank you.
Sorry, a little background noise here. So my question involves inflation. As you pointed out, we're going to be doing a lot of spending, federal, and we have been doing a lot of spending, mostly with borrowed money. So I'm curious what you see as that effect having on inflation moving forward.
Well, I think all the debt buildup, listen, Jim, if you go through history, the way governments really pay back, quote unquote, their debt is by inflating it away. You don't think we're ever going to raise taxes enough to run a surplus to pay back that debt, do you? No. It's going to be inflated away. That's why you got to worry about inflation. Now, again, I do want to emphasize, a lot of people have, you know, visions of Zimbabwe or the Weimar Republic or some crazy hyperinflation. I am not talking about that. I'm talking about moderate inflation,
Right.
but inflation nonetheless.
Right.
And we can protect ourselves against that sort of inflation.
Well, that was part two of my question. How do we do that?
Well, that's what stocks, real assets, will protect yourself with that. And we see land going up, houses going up, real assets going up. Stocks are real assets. And in fact, those stocks that have taken on a lot of debt are among my favorites because they're going to be paying back their debt with depreciated dollars. So leverage stocks, which a lot of people are worried about, no, they're going to do well. You want to be leveraged now. You want to fix in these rates that are at historic lows and pay back with depreciated dollars. Those corporations have borrowed a lot now. I'm not worried about them. I mean, in fact, it'd be smart for them to lock in these lowered rates. Now they come up a little bit, but they're still extremely low.
Right. Okay, excellent.
Thank you, Jim.
Thanks, Jim. Appreciate it. We did have a question text in from Vern. What do you think about cryptocurrency? I know you kind of touched on Bitcoin, but overall the cryptocurrency universe.
Well, I told you. I mean, I'm not saying it's not going up more. I'm just saying, and you know, and we have a kind of a crazy dysfunctional payment system that could be much better. I just don't see the cryptocurrency as being what I'm going to be carrying around. But yeah, you know, I'm going to talk about gold because it's, you know, obviously I think Bitcoin took the wind out of gold. If everything collapses, you know, or I'm on a desert island and I need to pay someone off to get off of it, do I want gold coins or do I want to get on the internet and try to give somebody a Bitcoin where the internet may not even be functional? I mean, you know, you don't need much to wipe out the internet. You can have a solar storm that wipes it out. There's a reason why gold has lasted 5,000 years. I prefer that as a longer term hedge against those disasters.
Okay. And is that also, another question was a concern about the national debt, which Jim just mentioned, and that the dollar loses value. Or, you know, there's a lot of commentary out there that it's going to become, you know, it's not going to be the currency of the world.
You know, that's also, you know, people go from one extreme to the other. So, yeah, dollar's going to go down. It doesn't mean that, you know, like a banana republic, is it?
Right.
I mean, that's ridiculous.
Right.
I mean, we've had much more inflation, and the dollar is still a reserve currency than we're going to have. We got to look at the reality. Dollar staying a reserve currency is just going to go down in value, maybe another 10%. So foreign stocks will therefore do very well for Americans.
Right. So foreign stocks.
It doesn't mean, you know, I mean, these people swing between, oh, it's the best thing in the world, and oh, it's going to nothing. No, the world doesn't act that way. You know, dollar's going down, still remains world reserve currency. It's gone down a lot further than it's gone down so far. So, I'm saying it has in the past. I'm not saying it will go down to the lows that it has reached at years in the past. But, you know, we're not, even the decline that we've had recently is relatively mild compared to past declines.
All right. We have a couple more questions. Go ahead and put those on the screen. This comes from Tim. Transportation industry has been absolutely hammered. The airlines, financial pundits say American Airlines may be a good place for some serious growth. What do you think? Do you think transports are a good place for growth at this point?
Well, I'm not a sector guy. I don't do those sort of sector things. I actually like financials better because I think interest rates are going up, and that will help the financials. Clearly, I also said I like value stocks, so I think there will be a reopening. But in terms of whether rails are going to do well versus airlines are going to do well versus, I don't think I'm going to wander into that's not my area of expertise.
Okay. Another one from Mike. Will the new Green Deal hurt the market?
No, I mean, we're going to have higher taxes. The world, I mean, we're not going to get all the new Green Deal. Young people want to pay attention to climate. We're ready to move to electric vehicles. General Motors, Ford, they're making big progress now. Could be the biggest threat to Tesla, by the way. So we want to move in that direction. No one wants to do anything extreme. I mean, I think we could raise the national gas tax, which I don't think has been touched for 25 or 30 years. There will be things like that, but the push that we've seen so far will continue, but that's the way the industry is going anyways. Still a lot of good prospects in that.
Okay. Another one from Mr. And I'm going to rephrase this a little bit. He was mentioning, waiting for a correction for years, but we're really alluding to even what you said in your book, where there's times in history where the market can kind of run away from economic fundamentals, and it's primarily driven by liquidity and low interest rates. And what impact do you think that will have on the market? in the longer run when earnings don't seem to support the run up, or you think that the actual run up will eventually?
Yeah, I think earnings are going to rise to make the run up right. Don't forget, stocks are the longest lived assets we have. You know, at the very beginning of the pandemic, I went on CNBC in February, and they said, how much do stocks go down? I said, well, let me tell you what finance says. If you wipe out a whole year of a company's earnings, it should, but the rest of the years are going to be what they would be before. The stock price would go down less than 10%. Just a present value formula that, we can teach in 8th grade. And I said that. I said, if we do have a recession, you're going to have it much greater than that, but I'm going to tell you what's justified. And what we see now is, yeah, we had a big dip this year, 30, 40, 50%. We're going to have a huge, last year, we're going to have a huge increase this year. We're getting back on track even better than before. We're growing into the earnings that we have. It's forward looking. You don't base stock prices on last year or even this year. You base it on the infinite forward stream of cash flows, which goes out to the future. That's what you're focused on. And from that point of view, I do not see a disconnect between the overall level of the stock market and the real economy.
So the stimulus and the low interest rates, the liquidity is the reflation.
The liquidity and the reopening with the vaccine, the cost cutting that corporations have done, and the promise of much higher cash flows.
So one more from Rick. You say federal taxes will rise. Why do you say that? Is it because of the Democratic administration?
Yes. And the Democrats have 51 votes. They will pass it.
Okay.
They can pass it under the reconciliation bill, as they will. They can use it twice a year, but they'll definitely use it for the infrastructure bill. You'll see the real tax increase come with the infrastructure bill. You might see it with the stimulus bill, but they're trying to do it without the stimulus bill. They don't want to use everything up, but they'll definitely do it with the infrastructure bill. I expect, sometime April, May, June, you're going to see a big tax bill come with the infrastructure bill. And that's my prediction.
Okay, great. So we got a reflation trade. We've got low interest rates. We've got liquidity. We've got opportunities in value. We've got opportunities in international and emerging markets. And we need to look for opportunities to reduce our exposures to bonds, because long-term, they're going to be a loser for the portfolios.
That's my belief. That's right, Justin.
Awesome. That's awesome. Well, I think we answered all the questions. So I'm going to wrap up here. I just want to say, Professor Siegel, on behalf of Connors Wealth and our clients, I want to thank you so much for taking time out of your busy schedule to share your 2021 forecast and your wisdom by answering all of our questions. We're grateful and truly appreciate this opportunity to spend some time with you.
I appreciate it. I really enjoyed it, and let's hope we can do it again in the future.
Absolutely.
Thank you very much.
Of course. Thank you. Thank you very much. And I want to thank Mike Marino of Wisdom Tree for putting this opportunity together for us. Thank Mike. Much appreciated, sir.
Very welcome. Thanks, Justin, company,
right.
And a special thank you to Dr. Siegel.
Of course. And I want to thank our audience today for listening in, and a special thanks to our advisory board members, Rick and Jim, for participating. Thank you. And we'll be sending out a 90-second survey, so please reply to the survey and help us get better. To our prospective investors, we'll be reaching out to you in the next day or two, and we'll be looking forward to learning more about you and your personal financial situation to see if we can add value to your financial lives. So with that, we want to thank you again for participating. Have a great evening, and we'll see you next time.
Thank you, Justin. Thank you, Dr. Siegel.
Thank you, guys.
All right. Thank you. Thank you, Professor.